Today, more mixed indicators. Hello again, it's Martin North from Digital Finance Analytics with latest post covering finance and property news with a distinctively Australian flavour. Well, of course, end of February, so we got the latest from the RBA and APRA relating to the credit aggregates and the total loans outstanding. And, well, we also got some retail figures from the ABS which were more positive. So trying to work out whether the economy is speeding up or slowing down remains complicated. We'll start by looking at the financial aggregates. The RBA said that in the year ending to January 2023, total credit grew by 8% compared with 7.6% a year ago. And within that, housing grew at 6.1% compared with 7.7% last year, so it's slowing. Personal credit is stronger, actually up 0.5% compared with down 3.6% a year ago. More people, I think, are reaching for credit to help them get by. And business credit was higher at 12.5% relative to 9.1% a year ago. And in the month, in January, total credit grew 0.4% compared with 0.3% last month. Housing was up 0.3%, the same as last month. Personal credit was slightly stronger, 0.1% compared with a fall of 0.5% last month. And business credit at 0.5% was a little stronger than last month. And broad money is easing back slightly, 0.7% compared with 0.8% month over month, and 7.3% compared with 8.9% a year ago. Now let's look at that in a bit more detail. Firstly, we'll look at the monthly credit aggregate movements. This is the housing, 0.32% higher, so it's still growing, but growing more slowly. Owner occupation was 0.42%, and in fact upticked just a little. Investment, 0.18% was lower. Personal credit, very volatile series, but up 0.13%. And business credit up 0.49%. Now these monthly numbers, of course, wobble around all over the place, so don't get too caught up with individual monthly numbers. If we then look at the total credit, up 0.4%, so slightly stronger than last month. Often you get that, of course, after the holiday period. And broad money is 0.74%. It's still a little bit extended, but nowhere near, of course, what we saw through the COVID period. There's an interesting correlation between broad money and credit availability, of course. Now, if we move on to look at the annualised rates, you can see that housing is now growing at 6.1% annually. So it's still easing lower compared with where we were a little while ago. Owner occupations at 6.6%, still falling, but still growing. And investment at 5.1% is dropping back a little faster. Personal credit is growing at 0.54%. This is a very concerning trend. I continue to see more people reaching for credit to try and get by, given the pressure on households and inflation hitting their budgets. And business credit at 12.54% is definitely easing back from its heights from last year. And looking at the total picture, total credit 7.99% is considerably lower than a few months ago and is probably going to continue to shrink. Whereas broad money at 7.35% is a little stronger than a couple of months ago, but still lower than where we were in February, March, April, May 2022. And then if we look at the 3 monthly one, which I think is probably the best intermediate indicator of what's going on, housing grew 1.04% and continues to deaccelerate. Owner occupation was 1.23% and is also slowing. And investment lending at 0.68% is slowing even more quickly. Whereas personal credit dropped a little over the 3-month period, but that, of course, was because of a significant change over the last 2 or 3 months. And business credit at 1.49% is considerably lower than previously. We can also then look at the total credit at 1.18% over the last 3 months. And again, you can see it's falling, whereas broad money at 2.19% is a little stronger than we were a few months ago. Then if we turn to APRA, looking at the monthly authorised deposit-taking institution statistics, in other words, the money of the banks. And here, the first number is 2.068 trillion. That's a new record high for total credit outstanding. And if we look at it in terms of contribution, owner occupation still growing, investment lending still growing but a little more slowly, and the total is 32.76% investment, the rest owner occupation. And you can see that owner occupation is now over $1 trillion, and the rest is for investment purposes. If we then look at the change over the month, owner occupation grew by 0.43%. Investment lending grew by 0.2%, and total credit for housing was 0.35%, neatly splits the two other figures. But you can see here the easing is continuing. And if we look at the portfolio movements, December to January, we can see that Commonwealth is out in front, ANZ and Macquarie second and third, and then NAB and Westpac. And Suncorp is also chasing down investment lending as well as on occupation lending. On the other side of the balance sheet, you can see ING and Bendigo and AMP are also going backwards in their portfolios. Now, of course, this is gross balances. It may be that they've done some securitization or something to change those numbers, but it does show you how concentrated the growth is amongst a few major players, and CBA is out in front. And I'll just make the general point that most of the lenders are focusing on the owner occupation side of the balance sheet at the moment. Now, just turning across the ABS, there was a bit of a reversal from last month. So last month we had a significant fall, nearly 4% down. This last month there was a reversal, nearly 2%, actually 1.99% stronger. So is that a timing question, or is that just the disruption from Christmas and New Year? Not sure. I'll have to watch the trends in the months ahead. But of course, anybody who thought that the signal would be for weaker retail and therefore the RBA could stop lifting rates is in for a bit of a rude surprise here. And in fact, the retail numbers were strong across all the states and all the territories, whereas they dropped in December 2022. In January 23, they were quite strong. ACT, of course, is doing the most well, maybe not too surprising given all the high pay in the public sector there. But also Victoria is outperforming New South Wales, and even Tasmania and Western Australia are stronger than New South Wales. So, as I said at the start of this show, really conflicting information. On one hand, we're seeing credit continuing to ease back. The growth is there, but slowing. A lot of that, of course, is refinancing. We'll get some new statistics out from the ABS in terms of the new lending, and that will tell us what refinancing is doing. My hypothesis is it's refinancing, which is really the only gain in town at the moment. Whereas the retail numbers, though they're stronger, good news is bad news, more likelihood of the RBA lifting rates. And in fact, I think ANZ is now saying maybe another 3 rate rises, and they're forecasting another fall in home prices over the rest of 2023, falling into line with some of the other prognostications that we've already seen. So we'll watch these data points in the weeks and months ahead, try and work out what's really going on, but it's certainly quite conflicting at the moment. This is Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.